Purchasing a home in Canada is about to get easier. If you've been struggling to save up enough for a minimum down payment, or if monthly mortgage payments seem unmanageable, there is some relief on the way. The federal government of Canada has announced some new mortgage rules that are coming into effect on December 15th, 2024. And in their own words, these changes are meant to, quote, unlock home ownership for more Canadians. Now, many people have been pointing out the fact that these changes are just as much about the Liberal government trying to get more votes in the next election as they are about actually trying to help more buyers get on the property ladder. But regardless of the political motives behind these changes, they are happening and they are going to affect the real estate market. And while these changes are primarily geared towards first-time home buyers, they're going to affect other buyers as well, and they're certainly going to affect the market as a whole. So whether you're a first-time home buyer or not, you're going to want to stick around for this video because I'm going to be breaking down the new rules in detail. I'm going to show you how they're actually going to benefit buyers, and I'm going to be looking at some of the pros and of course some of the cons as well. Welcome to the channel. Listen, if you're new here, my name is Jason Bondy-Sawyer with the Bondy-Sawyer real estate team in the city of Toronto. I've been a full-time realtor since 2006 and I help buyers and sellers make smart real estate moves. If you'd like to book a call with me to discuss your own real estate needs, you can do that using the first link down in the description. And if you get any value at all out of this video, please give it a thumbs up and go ahead and subscribe to the channel so that you see more of our videos in the future. There are two major mortgage changes coming into effect on December 15th, 2024. And these build upon some of the changes that the government implemented earlier this year as part of their 2024 budget. The first change is increasing the $1 million price cap on insured mortgages to $1.5 million. When you purchase a home in Canada, if you have a down payment of less than 20% of the purchase price, in other words, you're getting a mortgage for more than 80% of the purchase price, then that mortgage has to be insured. And that insurance is in place to protect the lender if you default on the mortgage. So the current $1 million price cap on insured mortgages means that any purchase of $1 million or more, and you're required to put a minimum of 20% down. When the new rules come into effect on December 15th, that cap is increased and the 20% minimum doesn't come into effect until you hit $1.5 million. But what that does is it now opens up properties within that $1 million to $1.5 million range to buyers who have less than 20% saved up for a down payment. So what does that actually look like? Well, up until now, it's looked like this. The minimum required down payment is 5% on that portion of the purchase price from $0 to $500,000. And then on that portion from $500,000 up to $1 million, it's 10%. But then as soon as you hit $1 million, the minimum down payment jumps up to 20%. And that's not just 20% on the portion above $1 million, it's 20% across the whole purchase price. So if you're buying a property for $999,999, the minimum down payment is $75,000. But if you just spend $1 more and you jump up to $1 million purchase price, the down payment jumps all the way up to $200,000. So with the new rules, there's no longer that drastic change in minimum down payment as soon as you cross the $1 million mark. Now, the drastic change is still there. It's just that it now happens as soon as you cross the $1.5 million mark. So let's use a $1.3 million purchase as an example. And just a quick side note here, this is assuming that the government is going to keep the minimum down payment at 5% on the first $500,000 and then apply that 10% from $500,000 all the way up to $1.5 million. Now, I haven't seen anything concrete on that, so just keep that in mind. For a $1.3 million purchase before the new rule comes into effect, you'll need a minimum down payment of $260,000. After the new rule comes into effect, you'll only need $105,000. And you can clearly see how the new rule is going to open up a whole new price range of properties to a whole new segment of buyers. So what are the pros of increasing the price cap on insured mortgages? Well, like I just illustrated, the pool of buyers that can now purchase in that $1 million to $1.5 million range is going to expand. Yes, they'll still need to qualify for that mortgage, but they can do so now with less of a down payment. In the city of Toronto, there are already plenty of buyers out there shopping in that $1 to $1.5 million range. And many of them have owned a condo for a number of years. So they built up some equity and they're going to use that towards their down payment. And then some of them are getting help from the bank of mom and dad. But what about those who have maybe made great strides in their careers. They've managed to save up a decent chunk of money to go towards a down payment, but they haven't managed to hit that 20% mark. Maybe they never bought that entry-level condo a number of years ago like many of their peers did. They rented instead, and they just don't have that equity. Or what about the ones who, frankly, don't have help from the bank of mom and dad? Because to be honest, not everyone has that advantage. But these people have worked hard, they've paid their rent, they've saved some money, but it's just not enough for 20% down. Up until now, even if they were well qualified to make those monthly mortgage payments, buying anything over that $1 million mark simply wasn't an option. They were hamstrung, but now that roadblock isn't there anymore. What was previously almost impossible is now going to be possible. But here's where the cons of increasing the price cap on insured mortgages start to become apparent. Some will argue that buying a property up in that higher price range has been impossible for some buyers for good reason. And I'm talking about people who maybe do qualify for that much of a mortgage, but really have no business taking on that much debt. And lower down payments means people are starting off with less equity in their homes, which means they are more vulnerable to downturns in the market. Just imagine if this new rule was in place back at the beginning of 2022 when buyers were paying peak prices. Now, prices have obviously come down in the last couple of years, and a lot of those buyers would now owe more to the bank than their property is currently worth. Now, aside from encouraging buyers to take on increased levels of debt, you can also argue that these new rules are going to put upward pressure on prices. Many homes in that $1 million to $1.5 million price range, at least in the city of Toronto, are highly sought after, and there is a good deal of competition among buyers. So what happens when we have more buyers coming into the market for those properties? We're already going to have more buyers coming off the sidelines in the coming months as interest rates continue to trend lower. These new rules are just going to push that even further. And increased competition between buyers means increased prices too. So the cons are pretty clear. Higher levels of debt, more exposure to downturns in the market, and higher prices. And each of those things has implications for what the real estate market is going to look like further into the future. Okay, rule change number 2, expanding eligibility for 30-year mortgage amortizations to all first-time home buyers and to all buyers of new builds. Up until now, 25-year amortizations have been the maximum amount allowed on insured mortgages. Back on August 1st, 2024, a change was made, and the government started allowing 30-year amortizations on insured mortgages if you were a first-time buyer and it was a new build. As of December 15th, 2024, this is going to be expanded to all first-time home buyers, so regardless of whether you're purchasing a resale property or a new build, and to all purchasers of new build properties, whether or not you're a first-time buyer. So what are some of the pros of expanding the eligibility for 30-year mortgage amortizations? Well, when you jump from a 25-year to a 30-year amortization, the cost of paying for that mortgage is stretched over more years. So what that does is it reduces your monthly payments. On a monthly basis, the mortgage is lower, so affordability is increased. Or alternatively, you could pay the same monthly payment, but with a 30-year amortization, you'd be servicing a larger mortgage, so your buying power is increased. So this is a big win for those buyers who qualify for a mortgage, but the monthly payments are just too high for them to comfortably handle, or for those buyers who are okay with the monthly payments, but the amount of mortgage they've been approved for doesn't quite get them up into that price range of the home that they want to buy. So what are the cons? Well, you're paying off your debt for longer and you're paying more interest as well. Let's take a look at the math. On a $500,000 mortgage with an interest rate of 4.5%, your monthly payment will be $2,767 with a 25-year amortization. Now with a 30-year amortization, it drops down to $2,521. So your monthly payment is $246 less with the longer amortization. At the end of 5 years, with the 30-year option, you'll have paid $1,742 more in interest, and the remaining balance on your mortgage will be $16,520 higher. On a $1 million mortgage with a 4.5% interest rate, your monthly payment will be $5,535 with the 25-year option, And with the 30-year option, it drops down to $5,042. So your monthly payment is $493 less with the longer amortization. And at the end of the 5 years, with the 30-year option, you'll have paid $3,485 more in interest, and the remaining balance on your mortgage will be $33,039 higher. So again, yes, you have the benefit of those lower monthly mortgage payments, but you're paying more interest and you're paying off that debt for longer. If you're looking to make a move, there are a few other videos here that I think you really want to take a look at. And over here is a link to subscribe to this channel. That's it for now, and I'll see you next time.